Well, hello everyone. It's live with Jim and Anna, and we're really glad to see you in March. We hope your weather is better, and we'll answer the question right away. Where are you? Anna, where are you?
Wow, Jim, this is actually an exciting question. I'll start with that. But do you know where I'm at? I'm in your office, and you're
Oh,
not here.
and you know where I'm at, Anna? I'm in your Santa Barbara office.
Gosh, I thought at
Nobody
least I
can ever
could catch
find
you
us.
here. How come we can't do a Google Hangout from one office, Jim?
Yeah, well, I won't tell you that in Santa Barbara it was 88 degrees yesterday. So, oh
Well,
well,
you
it's
know, it,
tough. It's
you know,
tough.
it wasn't a bad day yesterday in DC, so I can't complain about that. But I'm glad the snow has melted.
Okay, well, let's get to the questions.
Let's get on to the questions. Okay.
Ask me a question. Go ahead.
You want to go first? Okay, Jim. All right, here's a question for you. Now that I have retired and I have sold my business, and I'm not waiting to take Social Security until age 70 for both myself and my wife, how much cash should I have in savings account so that I don't have to sell my stocks or my bonds when the market is down? So
Well, Anna,
basically, the
that
question is, how much should I
that's
have
a
in my
traditional
emergency reserve?
question for a lot of people who are retiring. In this case, it was a business owner, so he had a fair amount of cash come in as he sold the business, but part of that cash is going to come to him and his wife in future years. So what we did is we looked at bucket one and we went over their retirement budget, which was about $100,000 a year after taxes, and we determined that, okay, well, we want to keep at least $300,000 in cash in bucket one, but would that go all into a high yield savings account? Well, probably not, because we're counting on the buyer sending him a check twice a month for close to $5,000. So I think we're going to count, and because they're still consulting to the business, they know the cash will be there. So we set up about 148,000 in a high yield savings account, and then we put 100,000 into bucket two, into in this case, a California municipal bond fund, to sort of having the year number 4 cash in waiting. And so having enough cash either on hand or coming in an income stream while you're waiting for Social Security to come in later as an income stream is a really good way to handle withdrawals, because you, in almost all cases, don't have to sell in a down market. We also set a safety level, Anna, that they would always have $100,000 cash, and when it got below that, they would automatically refill unless it was a certain bad time in the stock market and they were waiting for some recovery.
I like the safety level, Jim. That's something we should do more often. Could you also remind us about how the buckets strategy that we use when we plan our clients' investments and give advice? I think that's
Yes,
where this coming out of.
sure. It's a time-based strategy, and so bucket one, it doesn't have to be absolutely these time frames, but as a generic way to look at it, we like to have 3 years worth of cash in bucket one. Cash could be CDs, high yield savings account. It could be an income stream that comes from that buyer I mentioned. It could be an income stream that comes from an annuity that's already been annuitized and it's coming directly from an insurance company every month. Those are bucket one kind of investments that have no volatility either in the bond or the stock markets. Bucket two is sort of midterm savings. We know about how much we're going to need, but the time frame hasn't gotten so close that we need to be keeping that money in cash. So we can put it in the example I gave you, a municipal bond fund, but there are even some preferred stock indexes or other like a balanced fund, low volatility accounts that we can put that 3 to 7 year money in, which is bucket two. And then bucket three is where most of the retirement accounts and some of your taxable accounts go, and that's the 60-40, 70-30, 50-50 stock to bond asset allocation, your long-term money. And we hope that we're not going to have to sell any of that in a down market, because we have enough in bucket one and even in bucket two to wait out a down market.
That's a great answer, Jim. I wanted to add to bucket one a pension, income stream for a pension. So some of our clients have that because you mentioned annuity payments. So I think that would be something to also think about, a somewhat no market volatility exposure for the income stream.
Thank you, Anna. Well, I'm going to ask you a really tough question.
You will?
One of our clients wrote in and said, what should I encourage my 21-year-old son to invest in and start early saving for retirement and doing it at Vanguard? So what would you answer that question?
Okay. Before I answer that question, I want to remind our listeners, the ones who are actually viewing us live right now, on your screen on the Google YouTube page, on the left-hand side, there's a yellow button. You can click and submit a question, so you can participate in that with the discussions. So I just want to let you know, because sometimes we forget to say that, Jim, and all the way at the end.
Yeah, but they might send in a hard question, Anna, so be careful.
I know. I just want to give them. I want to have enough time to look at the question and be prepared. So there you go.
Okay.
Just remember.
I'll go on and on so you can look at any questions that come in.
Yeah, we can take a question. Just send it in now. Okay. So for the ones who are not listening right now, let me answer the question. Okay, so 21-year-old, and we wanted to start investment account at Vanguard. Is that just to read?
That's what his parents want him to do.
That's what the parents wanting to do. Okay, well, we are here at MainStreet are big fans of target retirement funds. And for someone who's that young and already interested in investing, a Vanguard Target Retirement 2050 or even 2055, I believe Vanguard already has, would be a good place to start. And so a target retirement fund actually has a couple of other funds inside of that fund. So you actually not only investing in one fund, you have a balanced kind of allocation, and the investments would be in S&P 500, a little bit of small cap, mid cap, international funds, and then also a little bit in bonds. So the 2050, the reason for the 2050 or 2055, for example, would be that the allocation for those funds inside would be a little bit more aggressive because you have all this time up until 2050 to maybe need to use those money. So for someone who is 21-year-old, I think that's a great place to do to start. You can also put automated savings, meaning you can automate your investments into that fund every month, and it's really easy to set it up on the Vanguard site. I'm not going to go into the details of what the ticker symbol is and so forth.
Well, I'm glad you wouldn't, because I wouldn't remember the ticker symbols anymore.
Right, but remember, Target Retirement 2050 or 2055. You can look them up on the Vanguard.com website.
Okay. What happens if you have more money? What would you do? So, because Target Retirement funds, you can open them up at Vanguard for $1,000. What happens if he was going to invest $10,000? What would you say anything different?
For a $10,000 balance. Mm-hmm. I guess I would like to see if this even 21-year-old has a little bit of money in the emergency fund first, and if that's not in place, I probably would focus on that. For a $10,000 balance, I would still go for a target fund. If we get to higher balance, yeah. If we get to higher balance, I think I would maybe give a couple more ETFs or maybe even just index funds to diversify the 2050 or 2055.
Well, I answered the question differently.
Of course you would. That's why there's two of us.
So I said that the Target Retirement 2055 is a good if it's a small amount of money, but maybe you split it between Target Retirement 2055 and the Vanguard Healthcare Index Fund. Because if someone's got 45 or 50 years left, I think that demographic over the next 10, 20, 30 years in healthcare is going to be doing really well. It's done for the last 30 years, not saying that past performance is predictive.
Yes,
exactly.
But
I think that would be, when you're 21 years old, you can bet on people who are older on you getting older and needing healthcare. So I would diversify it a little bit more than just the retirement index fund.
Okay, Jim. I'll take your answer.
Good.
Now,
Why don't you ask me a question then?
do you want another question? Okay, sure. Okay, so your question would be, here we go. I want to buy a rental property in Baltimore, and I'd like to make some estimates and calculations. Can you go over your 10-1-1 system, and when I do those calculations, what does it tell me?
Well, the 10-1-1 system is very simple. When you look at a rental property and you're going to maybe put 20 or 25 or 30% down, can you cover all of your expenses for the whole year, including mortgage payments and taxes and insurance and maintenance and all the advertising, all the other expenses that are affiliated with a rental property? Can you cover 12 months worth of expenses with 10 months rent? If you can, wow, that looks like a very profitable property. What do you do with a month number 11? You put that in a little fund called your vacancy fund, because in rental property sometimes you have vacancies but the mortgage payment goes on, so you want to have a little fund set up for that. And then the 12th month rent, you put it in the maintenance and turnover fund, another little fund that you set up. And so after about 3 years, you have your fund for vacancies and you have your fund for turnover and maintenance. And then in year number 4, you can start taking those last 2 months' income streams as profit, and you've got a viable rental property starting off from day one. So you have to look at a lot of properties and make a lot of offers and do your homework before you can have a cash flow positive rental property with a mortgage, and that's what I use the 10-1-1 system for.
One comment here, Jim, it's somewhat difficult to do it in the coastal United States to find a property that can cash flow.
But it's doable. It's doable in Baltimore, and this this client is a Los Angeles client who has kids and grandkids in Baltimore, and she thought, well, I think I'll have some rental property there, and by having rental property in a town with kids and grandkids, what other opportunities are there just besides an income stream?
Mm-hmm. Mm-hmm.
Anna, that's a question.
Is this I'm sorry, I just thought you were just commenting.
No, I'm asking you a question. I said, what other kind of opportunities are when you own a rental property in the same city that your kids and grandkids live in?
What kind of opportunities?
And it's across the country from where you live.
I'm not sure what exactly you want me to
Well,
answer.
it's tax-deductible trips that you make to see your property.
Okay, so from I was just thinking, not from the financial standpoint.
I got you. I got you.
Are you talking about? Still talking about?
This is an unscripted show, but always think tax deductions.
You like to put me on the spot. Yes, tax-deductible trips to go check out on your property.
Right. Well, you know that, Anna, that in Santa Barbara we have an office, but what also exists in Santa Barbara for me?
Besides an office?
Yes.
Your grandkids?
Of course. Now, I'm working all day long, but after hours, I have opportunities.
Yes, and your kids too, and that's why you like to go there.
So buying rental properties, to get back to the question, if you have a cash flow positive property and some other ulterior motives, why not?
I like that answer, Jim. We're coming on to our time, and we still have one question to discuss.
We do?
We do. We have one more question.
Okay.
Should we leave it for the next time? No, we should.
We should answer it or leave it?
No, we should answer it.
Okay. So, should I reinvest dividends in my taxable account?
Yes, let's answer that. So typically, at least on my side, I have recommended to reinvest dividends because I just find that to be easier as opposed to have them accumulate in your settlement fund or your money market. But one client has pointed out, or asked a question actually earlier this month, because he read an article that talked about why not to reinvest dividends in taxable accounts. And so I wanted to kind of go over some of those advantages and disadvantages. So why not do that? Well, for once, is when you have your either exchange-traded funds or your mutual funds dividends being reinvested back into the same fund or exchange-traded fund, what happens is you create what's called a little tax lot. So every time you buy new shares of mutual fund or exchange-traded fund, you create a new track record, which is like a new cost basis. So for record purposes, that creates a lot. If it's not tracked appropriately, it creates a little bit of a headache as far as trying to figure out at the end, when you try to sell that mutual fund or exchange-traded fund, what your actual cost basis is, because you have to add all those little lots of reinvested dividends to your overall balance. So not to do that, it just simplifies your records. And so if you're not doing it, you would accumulate your dividends in your settlement fund or your money market. And then it leads me to my second point, is that balancing of your portfolio becomes a little bit more efficient in the way that the dividends that you accumulated in your settlement fund are now available to, say, for example, if you had a 60-40 or 50-50 portfolio and the stock market or bond market changed it, now you have this cash that you can use to rebalance, as opposed to just selling one of your other investments to generate the cash to rebalance to bring back to whatever allocation you have. And then some of the disadvantages, well, some people aren't as disciplined as they would like to be, and so if you don't reinvest the dividends and just leave them in that settlement fund or money market, then they just sit there and really do nothing for you. So in that case, you might as well just reinvest them. And one other comment too is, depending on which custodian you have your accounts, there might be also savings on fees. So if places like Vanguard or Fidelity, there's no fees, trading fees that I'm referring to. So you kind of have to look at that and say, okay, does it make sense for me to pay a trading fee every time a transaction happens? So those are my comments. So I'm not sure if I'm changing my my strategy about not reinvesting your dividends. I think it's going to be more on individual basis, and it depends what clients' behavior is like, because we still want to encourage them to continue investing. And so rebalance, dividend reinvestment is one of those just easier strategies, I think.
Can I make a comment or two?
Anything to add?
Yes, I do. Thank you,
Right,
Anna,
of course.
For smaller accounts, reinvesting is probably not a bad strategy. Starting January the 1st of 2013, custodians have to keep track of new purchases and the cost basis. So these little purchases every month or every quarter probably aren't as big as an accounting problem as it used to be. The transaction costs are an issue if you're buying at a custodian where they're not offering you free trades or reduced commissions. And for larger accounts, most money managers accumulate cash from the interest and dividends, and they use it to rebalance because you end up with one transaction rather than two. And I know I have, Carol and I have accounts at one custodian where they do charge us for every trade. And so I'm very conscious of the trading costs, whereas at Vanguard and some other places where I'm using their own funds or exchange-traded funds, I don't pay any commissions. I'm not as concerned about that. So it all depends on the size of the portfolio and what custodian they're at.
I think also one thing to mention, it also depends whether it's a taxable account and a retirement account.
Yeah, I thought we were only talking about taxable
accounts. I know, but I wanted to bring that up again. Yes, we were talking about just taxable accounts.
Okay.
All right. I think we're over time. Jim, you talk too much.
Thank you, Anna.
Well, that's why we have this show.
I've never heard anybody declare that I talk too much before. This is breaking news. Let's
Okay.
change the banner from my name to breaking news, okay?
Yes. Your little
Let's
title.
wish everybody happy spring. How many days till spring? Not too many.
Spring is on what day? March 21st?
First,
22nd.
yes.
Okay.
And I want to wish everybody in California rain, because we need it.
Yes.
And everybody back east, sunshine, because we need it too.
Okay, Jim. Safe travels. I'm going to enjoy the rest of the day in your office on your computer.
Thank you.
Okay. Take care,
Bye,
everybody.
everybody.
Bye.